Good morning. Welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Hormis Fatakia and Reema Tendulkar. Hey, guys. Happy Friday to all of you. But looks like for the markets, it's a day of further fall. In fact, we, fell below that 25,300 mark yesterday, 400 mark yesterday. Today, we are below that 25,200 mark. And in just last couple of minutes, we are at the day's low. So Nifty is down around 190 points. We have mid-cap seeing cuts of almost 600 points. Bank Nifty down 0.5%, and this week itself we have seen Nifty declining by around 1.1%. We have seen mid caps down, but IT space, of course, you'll talk about it in greater detail, Reema. That's the top loser in terms of sectoral losers, and PSU banking index as well, not doing so well. So looks like the consolidation theme that we were talking about, that's done with, and now markets are like, we are done with that consolidation and range bound phase. Let's show some colors.
Indeed, it's given way to weakness now because week to date, the Nifty is down more than 1%. The mid-cap index is a cut of nearly 2%. It's a twofold problem, right? One, of course, weak start to the earnings season with both TCS and Tata Elxsi disappointing the street, and even something like an IREDA, right? Maybe it's a one-off on account of Gensol, but there was a miss in terms of asset quality. And secondly, even, this tariff uncertainty is still lingering on. More than 20 letters have gone on. The start date is going to be 1st of August, but it basically means that from now to 1st of August, the negotiation is going to continue. So it's just this extended negotiation period has also prolonged the uncertainty, for our market. So it's now looking quite muted.
Friday fever, if you could call it that for
I thought Friday fever was positive.
The fervor was positive. Friday blues, if you would like to call it.
No, we have to keep...
Sorry.
I think Hormis has spoken. It's Friday fervor means positive, Friday fever means negative. This is it.
We'll go with that. But it's nothing different for the mid-cap index as well. Actually, that's bearing the brunt of the bigger sell-off here. 650 points lower on the mid-cap index, and predominantly led by the earnings reaction that has come in on stocks like Ireda. Stocks like Amber Enterprises also not doing fairly well for themselves. And most of these capital market names are taking a bit of a beating today. BSE down almost 3.75%. CAMS is down close to 3.5%. So CDSL too down around 3%. So it's not been a very good week for a lot of these capital market names. Same is the case for these defense names. They were down yesterday. They are down further in today's session as well. BEML down 3.5%. Data Patterns down 3.5%. Garden Reach down 3% as well. So it is defense, it is capital markets, all of these movers, the outperformers of the first half, seeing some bit of selling pressure now as the markets are moving lower. Now, in fact, the Nifty is now heading towards the 25,150 mark, comfortably below that 20 DMA that it earlier managed to defend and then moved higher. But then that recovery has been very swiftly sold into. But as Reema was highlighting, two poor earnings numbers came out, one from TCS, the other from Tata Elxsi. And the Tata Elxsi number is not spoken about in greater detail considering the focus was on TCS. But it's a very disappointing quarter there as well, Reema.
Indeed, and just I think the stock price over the last couple of, I think now 3 years is telling the story. The all-time high on Tata Elxsi is 10,760, and now we're sub 6,000. So it's been a sharp fall. In the last 3 years, the stock has given you a negative return of 27%. So basically 3 years, you've not made any sort of a return. But what has happened is that in the last 3 months, the stock had started outperforming some of its peers. So in the last 3 months, Tata Elxsi, even after today's fall, is still up nearly 23%, which is exacerbating the fall. Now let's get to the reasons why the stock has been weak. One, of course, this was the 4th consecutive quarter of a miss. Revenues are down 9% on a year-on-year basis. Secondly, revenues over the last 3 years have materially fallen. When the stock hit those all-time high levels, at that time, the revenue growth rate of the company was close to about 34-35% thereabout. It's been slowly declining, and now in the current quarter, both Kotak and Morgan Stanley are anticipating a revenue drop. This year, Kotak is also a negative. It's a decline of 4.6%. It basically means that it's going to be a negative year of growth of nearly 4%. So, that's disappointing. And then, of course, valuations are on the higher side, as we've been highlighting. Despite the correction, it's still trading at 42 times. It's just that at its peak, revenues were growing at, 30-35%, and the stock commanded a valuation premium of about 60-65 times forward multiples. So, earnings are getting compressed now, and valuations have gotten derated. understated, but still analysts say 42 times is very expensive for a company which is going to give you negative growth this year.
That's right. Growth is compressing, and that's the major
It's
concern.
minus 4% is the estimate on the top line, right? So it's not even like,
Growth,
some growth.
single-digit growth.
A single-digit growth.
decline
It's a decline this time.
Okay, explains the move that we are seeing on Tata Elxsi, and in the month gone by, it's down 11% already. But Hindustan Unilever, that has seen a big change, announced the appointment of a new managing director and CEO. This is effective August 1st itself. Mangnam is joining in now, and he'll be talking about what is happening and how's the stock reacting.
Well, it's a big change and a big stock price move. Just for perspective, the last 5 years, the stock gave you 8% returns. And just on this announcement, the stock is up nearly 5%. So it's doing what it hasn't in the last 5 years in just about one day. What exactly has happened? Rohit Java, it's a surprise that he's stepped down as MD and CEO within just 2 years of appointment. So that's one of the shortest stints for a leader in HUL. And this, he says, is to pursue the next chapter in his personal and professional journey. Remember, the last 2 years from a macro standpoint have been very, very weak from a consumer sector perspective. And that's reflected in the kind of numbers that HUL has also reported. It's been fairly tough. But importantly, now the leader is Priya Nair, who has been appointed as MD and CEO to succeed Rohit Java. She's currently the Executive Director of Beauty and Wellness for Unilever, Beauty and Wellbeing, that is. And she's been a Unilever lifer. That's how most Unilever leaders are. 1995 is when she joined HUL. She's known for digitization, premiumization, and brand building for the home care business in particular, which saw a fair amount of growth. And while she was in Unilever Global as well, the premiumization play really happened. Priya Nair is the first woman CEO of HUL. It's the first time, but also I think about time, given the sort of leaders that they've spawned in other companies as well. Prabha Narasimhan is ex-HUL, Geetika is ex-HUL, who's currently the MD of Nivea, and you have so on and so forth as well. So now the question is, from here on, what the focus will be for HUL on. Most important will be on recovery in volume as the consumer sentiment is turning. Now, because she's been leading, beauty and well-being, and that's been called out as a macro trend for HUL in India and Unilever as well, how that business grows is something we'll be watching out for. And finally, we'll watch out for innovation in foods portfolio post the ice cream demerger, because that portfolio hasn't done well ever since the Horlicks acquisition has taken place. The stock has done nothing over the last 5 years, but in the prior 5 years had moved nearly 4 times. So can this be an inflection moment for HUL or not? Is the big question we'll get an answer to.
First time, but about time.
About time. I love it, yeah.
That's the more pertinent takeaway from that.
HUL was established in 1931, which means it's taken it 94 years it's nearly a century to get its first woman CEO.
Well, times are changing, and hopefully changing for the better as well. It was woman CEO after 92 years for HUL. Of course, it's showing up in the price as well, 5% higher on that stock. But from losers to gainers and back to losers, then the other one being Z Entertainment. And that stock is under pressure today. The company's plans to raise funds hit a roadblock, and Vamakshi is here with more details on that. Vamakshi, well, the proxy firms had advised doing so, and the same has happened.
Well, absolutely. The shareholders have gone ahead and actually listened to what they had to say. The special resolution, which was to approve issue of convertible warrants to promoters, failed to get the requisite majority. When we look at the number of shareholders who voted in favor of this, stood at 59.5% and 40.5% were against it. Now, to pass a special resolution, minimum 75% votes need to be passed. So therefore, largely the resolution was defeated in the special meeting that was held yesterday. Keep in mind, like you pointed out, earlier 3 proxy firms, IIAS, SES, as well as InGovern, had recommended voting no to the issue, and some of the key objections revolved around the rationale behind the fundraise, given that the company already had 2,410 crores sitting as cash on the books. Apart from that, there were also concerns raised with respect to the choice of the financial instrument, which is the convertible warrants, and that in turn would have led to almost 15% dilution for the non-promoter shareholders. Resultantly, given that the resolution was defeated, the promoter shareholding will still stand at 3.99% as compared to 18.39% is what it would have stood at if this was given the go-ahead. So negative news flow for Z Entertainment, the stock down and out in trade today.
All right, yes, and we had an interview or a conversation with the proxy firms as well. They actually advise shareholders against it, and that's actually gone ahead and happened as well. So the stock is down 4% as we speak. We'll slip into a short break now. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. There is plenty of choppiness in the markets. In just a few minutes, we have seen a 150-point move on the Sensex from the day's low. The Nifty 2 at one point was down almost towards 25,150 and has seen almost a 60-point recovery from the lows of the day. But shifting focus to the commodity space, but more than Bitcoin hitting a record high today, the bigger occasion is that the OG commodity champion turns a year younger, and Manisha Gupta is here with us. Manisha, very, very happy birthday to you, and it is only apt that it is on your birthday that Bitcoin has hit a record high. Tell us
and silver as well.
And silver as well, of course, yes.
Okay.
And copper too.
Are we missing out on anything? Just tell us.
Well, thank you so much for that. I will start with Bitcoin, though, because this is where the major action seems to be coming now. You know, when I woke up in the morning, Bitcoin was trading at 116,000, and it was an all-time high. It walked up to 117. It's almost at 118,000 at this point in time. So it has been a very strong gain that we've seen happen in Bitcoin. In this year, until now, we are up by 26%. When you look at the last 12 months, we are up by 105% for the Bitcoin in sense of prices. So very strong gains coming in for there. Well, remember, this year started on a very, very strong note. Institutional demand, ETF inflows, corporate adoption, all has been supportive. And add to that on what US really has been doing in sense of making crypto coin friendly regulations. And we do understand that more supportive policies from the Trump administration can be expected going forward from here. Very interestingly, the Trump media and tech group has filed actually with the SEC to launch crypto ETF. Now, Trump media and tech group is going to be the 6th company which is filing for a Bitcoin ETF. Remember, we've done billions of dollars of trade since the time the Bitcoin ETFs have launched. And this is the reason you've seen institutional investment or money flowing into the Bitcoin markets there. Also, crypto week begins from 14th of July, and the expectations are that you could be listening to various high-profile statements, some more regulatory push as well, some more crypto papers could be coming in from various countries, and that is something that crypto as a market would keep an eye on. What led to this very strong run-up in the day today has been the shorts being wiped off. We do understand from various reports that nearly $1.13 billion in shorts has been wiped over. This is the biggest liquidation that you've seen in matter of hours, the biggest that you've seen in 2025. The data also shows that nearly 237,000 traders were in the short, and 90% of overall trade was in the short. So clearly not too many people were betting on higher highs, at least so early right now, and they were looking at prices perhaps going below a lakh as well. But that hasn't happened, and the shorts liquidation is what has led to prices running up at this point.
Okay, take that point. But Manisha, it's Friday, it's your birthday. Bitcoin is hitting a record high. I think all these factors, we need a party.
Done deal?
That was so easy. I didn't have to convince you. I'm so glad. Okay, thank you, Manisha, for joining in and wishing you a happy birthday yet again. But with that, we'll slip into a short break. But remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour. Let's get a conversation on a particular sector, that's the specialty chemical space. In a recent report, Kotak Institutional Equities says they anticipate mixed results amid continued industry-wide challenges as the overall supply-demand scenario in the world chemical industry remains unfavorable. To discuss more on this, Abhijit Akela, who is an analyst at Kotak Institutional Equities, is joining us now. Abhijit, good morning. Thank you for joining in. Well, you know, the conversations that we've had with corporates, they were indicating that maybe maybe demand is coming back now. Your note says it's going to be a mixed set this time. Can you explain what are the reasons? Is it going to be a volume-led recovery, if at all? What's happening with pricing and demand now?
Sure. Good morning. I think while there is some improvement in results across a set of companies in the past couple of quarters, that seems to be stemming from the fact that there's a very easy base effect from last year. In addition to that, there's probably been some benefit from tariff-related front-loading of orders coming in from the Western geographies. And in certain specific product categories, there have been rising prices. For example, if you look at the HFC refrigerant space, which has boosted business for the likes of SRF and Navin Fluorine. And then in addition to that, certain companies have specific growth projects that are in ramp-up mode. So it's really a combination of these things that are leading to the pickup in revenues and earnings that we are seeing on a year-on-year basis. Actually, when you zoom out and look at the overall industry context at this point, and you look at the commentary coming from Western companies, such as the likes of, say, Dow Chemical or LyondellBasell, companies are generally cautious about the demand environment. There is still a considerable amount of oversupply sitting in China. And prices, barring a few pockets where they've gone up, have not really been, firming up of a low base. Plus when you factor in, the concerns going forward, such as, for example, the tariff-related uncertainties, which are really expected to play out only in the second half of this year. It's not a very, I would say, very encouraging macro environment just yet at this point anyway. So, that's broadly how things stand.
Okay, all right. So that's different from actually what you're hearing from some of the corporates as well. They didn't exactly say it's going to be a major recovery, but they did indicate there could be some recovery, so to say. On this tariff-related issue specifically, Abhijit, we don't have the contours out yet, but Aarti Industries did tell us that maybe the US tariff negotiations, what's happening with China, what's happening with the other Asian countries, that could be positive for India. Is that an indication that you're getting?
Very hard to hazard a guess about what exactly happens in the US in terms of tariffs, because that is a moving picture pretty much on a daily basis. But I think the broader point I just wanted to highlight is that there definitely has been some element of front loading of ordering coming from US customers, or maybe even global customers sitting in Europe who are in turn supplying to the US, because they've all been trying to beat the tariff deadline. And therefore, there is a good amount of inventory creation that has already happened in the last few months. We've seen companies like Kumai Chemical, for example, which is a major customer for PI Industries, highlighting such a development. So the concern going forward is that as this inventory overhang maybe starts to exert an impact in the second half of fiscal 26, could there be a slowdown in ordering coming from agrochemical customers or customers in other sectors?
Abhijit, good morning. Thank you for joining in. You mentioned in your note that there is a mixed trend that you're projecting, right? Stocks like Navin Fluorine and SRF could benefit, that PI Industries has a higher base, but Aarti and Deepak Nitrite continue to remain under pressure. What could work for companies like SRF and Navin Fluorine? Navin Fluorine has done fairly well in the recent past. It has also just completed a fundraise through the QIP. What are the likely triggers that can result in these companies outperforming over, say, the next 6 to 12 months?
So from a business standpoint, both companies are benefiting from the increase in HFC refrigerant prices, particularly R32. In addition to that, of course, SRF has been, guiding to 20% growth in its specialty chemicals business on the back of a recovery in agrochemical demand. Things have picked up on that front in the last couple of quarters, but as I mentioned, the risk or the concern to watch for is how much of that is front-loading led because of the tariffs, and therefore will there be a slowdown in coming quarters? So that's something to watch for. From Navin Fluorine's perspective, obviously now having completed the fundraise, one would expect them to announce growth projects in the next few months or so. And then that is where the street's attention will shift. Navin already has a pretty strong pipeline of projects to execute over the next couple of years, which, by the way, is already factored into everyone's numbers. So I think the expectations for both companies already build in a significant amount of growth over the next couple of years. But in our opinion, the valuations already factor in most of that expected ramp.
You've spoken about UPL, saying it's going to be the weakest of the lot owing to challenges in Latin America and currency headwinds. Explain to us what we should expect from UPL. And the stock, I see, at least in the last 1 year, has done very well. It's okay. It's not bad. 16% up. Year to date, it's been a 30% up move. Now, given that it's going into its earnings with some gains, how would the stock fare over the near term?
Yeah, so when I mentioned weakest, I was actually referring to it in the context of the agrochemical peer group, not the broader chemical segment. The point here is that because they cater primarily to the international markets, and in particular, Latin America is their largest geography, which accounts for about 40% of the company's revenues. And Brazil in particular, which is the largest country in that region, is going through some very difficult times in the agrochemical industry. There has been more than a dozen distributor bankruptcies in Brazil in agrochemicals over the past year or so. So in that context, it's a difficult environment to show volume growth in. There's also a lot of Chinese competition that's been, flooding the market, plus therefore pricing pressure as well. So from all of those standpoints, it's going to be, one should expect maybe a subdued revenue growth for UPL this quarter on a year-on-year basis. Of course, it's seasonally not a large quarter. UPL's year tends to be very heavily back-ended, but we are already past that seasonal bump. And so, a soft quarter on a year-on-year basis in terms of growth. We should expect some improvement in margins, but then they will probably be some impacts from foreign currency related impacts because of all the currency volatility across the globe. Possibly one will also have to wait and watch if there are any settlements with any distributors regarding collections and whether that has an impact on the P&L.
Got it. So Abhijit, now that we are talking about cautious demand or maybe uncertain demand going forward, what are some of the spaces, barring agrochemicals, where chemical companies are investing or looking at investing, where they can get better returns or at least better orders going forward?
Yeah. So from our perspective, there are three stocks that we've been positive on for some time now. These are specifically Acutaas Chemicals, previously known as Ami Organics, which is primarily in the pharma CDMO space, but is also making a big thrust into the semiconductor chemical space through a recent joint venture they've announced in Korea. So we kind of like that story. We think there is good growth visibility there for the CDMO business, as well as, beyond that. SH Kelkar is the other one. We think that's an interesting idea, undervalued in the flavors and fragrances industry, where growth prospects are steady and there's a lot of operating expenses already built into the company's P&L. And so there's scope for operating leverage to play out over the next 2 to 3 years. The third one that we believe is still at reasonable valuations is Godrej Agrovet. So it's a very diversified story there, but we think that there are turnaround initiatives underway, across some of the more subdued performers. And there could possibly be an option of a demerger at some point in time as well.
Abhijit, thank you for sparing time and joining us to take us through this entire chemical segment, as Abhijit Akela there of Kotak, to talk about what to expect from the chemical companies this time around. By the way, we started Manisha's segment with the Nifty back above 25,200, but then we are back towards the lows of the day now. 25,150 is where the index lies, 200 points lower. The Sensex is now down 700 points. So that brief recovery that you saw has been sold into as well. All of them, TCS, Infosys, Bharti Airtel, Reliance, HDFC Bank, all of them contributing in excess of 20 points to the Nifty downside. So 1/5 of the Nifty fall is coming in courtesy of these 5 names. Take a short break, focus back on earnings on the other side. This time around, Kumar Rakesh from BNP Paribas joins in to put the spotlight on the IT sector. Stay tuned.
Well, let's get back to talking about TCS. That's the top Nifty loser. the company disappointed on its top line. It's the global macro environment. There were delays in a lot of deal closures, pauses in the deal, so they started late, and as a result of which, even their international business, which is ex of the BSNL deal, had a degrowth of nearly 0.5% versus the management's own expectation of a little bit of growth. They said, this quarter missed their own estimates by nearly 100 basis points. But we had a chance, Prashant and I, to catch up with the CFO of the company and the CHRO, Samir Seksaria and Milind Lakkad. And this would be Milind's last interview as the CHRO. He hangs his boot, retires on the 30th of September. Listen in to our conversation.
Two perspectives. If you look at last quarter, we did call out, given the uncertainty, from a headwind which we called out was that operating leverage might be impacted with higher utilization, and that is one thing which played out. We anticipated growth and invested in capacity, whereas we saw towards the end some demand contraction coming in, and that was one impact. In spite of that, we delivered a 30 basis points margin improvement. A considerable part is coming from BSNL and some currency benefit coming from it, offset by what we spoke about before.
I know BSNL is not a popular topic, but I kind of press on it every quarter. The new order, the BSNL order, can you give us broad contours? Is it? I mean, the last one was 2024. You got it right. That was the $2 billion order, which is winding down now.
Which was for the 100,000 sites. Whatever the order was, yes.
And the size this time is about $350 million.
So 26,000 sites. It's about 2,900 is the APO which we have received. APO is just the advanced PO. The circle-wise POs need to be received, so it's not in the TCV this time. So once we receive the circle-wise PO, that's when the execution
and it gets starts to get implemented from Q2.
Once we get it, it should come in Q2 positively, and then the execution starts. I think the 100,000 sites were delivered at record speed. We'd expect a similar
and relative to the margins, your margins, is this order once again like the previous one in that sense dilutive?
So relatively margins would be differential. It's in terms of it's very similar to the previous one.
Milind, before you go, wage hike is coming. Quantum, timing?
See, we're still calibrating. We're still yet to decide in terms of how the business situation will turn around and when will it turn around, and based on that we decide. So we have not made any decision on that front yet.
Okay, got that. Also hiring. You all hired ahead of demand, anticipating demand. Demand didn't come through. So now clearly you're sitting on a lot of bench strength. And demand is still uncertain. So what's going to be the hiring plan for the remaining? I mean, as of now.
See, these things do happen in our industry, and I always talk about that. Sometimes it is not in line with what you see on the revenue side. Sometimes it is because of the investments we make. All of that happens, right? And that's how you should look at it this time also. Going forward, we will definitely, depending on the business demand for both. From the market and from the campus, we will calibrate and decide how many to get in every quarter.
Samir, full year margins. Kriti was telling us that at least the international market growth in FY26 should be better than FY25. On margins, how do you think this year will pan out versus last year?
So overall, the only guidance which we have given is the guiding beacon, and that stays. Right now, given the overall macro and uncertainty which prevails, our focus is in terms of going ahead and capturing the demand, looking at what our client priorities are, and investing for ensuring long-term growth with profitability.
But considering that there is negative operating leverage because of lack of growth, what measures are you taking in terms of margin defense?
So as Prashant also pointed out that we have built up capacity, we already have. So we have capacity for the future.
So now hiring should be, you think it's frozen, would you say? No. Tactical will take place, but...
No, it will, I will never say it's frozen, but we will calibrate based on what the situation is.
Sorry.
Calibrate is business speak for...
coming back to...
It's not frozen?
No,
it's not only one-way street, right? It would be a balancing act on various parameters.
We have a certain attrition also, right?
So, but is that attrition linked to, because you didn't give wage hikes?
So
you typically give it in April. That didn't happen. So did that result in higher attrition this time?
No. See, the point is overall, based on the market situation, and now this is the first or second time we have done something like that, So, and continued communication with our people is the key, and we continue to do that, And I don't relate both of these points that 13.8% with the fact that the wage hike is not given is not the only reason why people leave.
Not the only reason.
Samir, talk to us a little bit about the environment, right? I mean, just an anecdote. The tariffs on Brazil came at 50%. I was talking to an economist and I was asking him, have you put pen to paper and changed estimates for Brazil? He's a global economist at a MNC bank. He said, no, we've not made any estimates because we don't know that 50% will be there, or by August that 50% will be 25% or 20%. So they've not made any changes. I mean, and that's quite telling. I mean, my question to you is, are businesses responding like that, or businesses are, as you see it, panicking because with what is happening, pulling back? Kriti described it as tactical sort of ramp downs, maybe deferment of projects, etc., but tactical in nature. So what are you seeing?
I think, as you called out, a start-pause scenario and specifically on a trade situation gives no one comfort. So I think I see it as a lot of enterprises being on a wait-and-watch mode on getting more clarity as it happens. But that uncertainty impacts us more because in a wait-and-watch mode, everyone starts getting cautious, delays start happening, and that is one of the reasons what we saw play out in Q1 against what we were planning for.
The deal booking value is also, but although that is a lumpy figure.
Yes.
Did it include any mega deal?
No, it did not include any mega deal. The BSNL isn't there in it.
Is not included as a part of it.
Because it's only an APO.
The percentage of cost takeouts versus discretionary, has cost takeout even gone up further?
Yes. The primary demand drivers have been on cost optimization and vendor consolidation. Discretionary is under pressure.
Okay, let's get some perspective. What should one do with the stock now? It's fallen about 2 to 3%. Should you bet on TCS, after the fall, or is there more pain ahead? Rakesh Kumar, Rakesh, the India analyst for auto and IT at BNP Paribas, is now joining in with his thoughts. Thank you for joining in. First, throw some light on, we know about the numbers, we've spoken to the management, but in terms of the stock, the valuations, because relative to many of the large cap peers, TCS's premium valuations no longer exist. And also funds have started getting a little underweight on TCS. So keeping that in mind, give us your thoughts on how the stock price will perform from here.
Good morning, Rima. That eventually is one of the silver lining of all the numbers which we have seen, which have been disappointing. But the fact is, on valuation, a lot of these risks are more than priced in. On PE valuation, which you're referring to, the premium relative to some of the other peers is no longer there. But more importantly, on some of the other matrices like dividend yield, TCS is trading at the highest it has ever traded. And the reason I'm bringing in dividend yield is because these companies have gone through significant transformation on the balance sheet cash flow side. The payout ratios have materially improved. Some of these things do not get captured in the PE valuation. And that is what the dividend yield is telling us, that at least the downside from here is quite limited. But at the same time, possibly the catalysts are missing for the next quarter or two. And that is what the market probably would be waiting to watch out for. And there are some of the other names where there could be relatively more growth outperformance, and that may, relative to TCS, may start looking more attractive, such as Infosys.
Kumar, thank you for joining in. Since you brought up dividend yield, is that the only metric that one could think of for staying invested in a stock? Because at the end of the day, capital appreciation is also important, right? Because you say that the headwinds are factored in, yes, but there are no triggers over the next 2 quarters. What if further headwinds emerge? The street does not like uncertainty, right? They would want to have clarity, and clarity is something that is lacking at the moment.
You're right. Yeah, dividend yield gives you a perspective in terms of if there is any further downside risk or not. The TCS is trading at about 3.7% 1-year forward dividend yield. Today's correction would have moved that a little higher. And that essentially tells you that, okay, from here on, possibly the downside risks are not there. But the point which you're talking about of the demand environment and the catalyst, that still needs to be there for the outperformance or the stock to start moving up, which is the point which I was referring to. Given the weak first quarter, possibly the full year outlook also is quite muted compared to some of the other peers. And hence, that premium valuation which used to be there may take some time to come back. And that's why relative to TCS, some of the other names may start looking more attractive.
Okay, so the next big number we'll be watching out for will be Infosys. It doesn't report numbers next week, but around 21st, 22nd. What is the expectation there?
So if you look at the stock price reaction today, probably market has already started pricing in that there is some degree of miss across all the IT services companies. There's not much to cut on valuation. So today's stock price reaction is largely reflecting earnings cut possibly happening through the earnings season this time around. And that sets relatively easier base or expectation going into Infosys result. Consensus was expecting close to 2% sequential growth, including acquisition possibly. And some of the expectation also is of the lower end of the guidance being raised. I would expect those expectation would have come down post the yesterday's result. And if they are able to even meet the expectation, that would be positive going into the result.
All right, Kumar, thank you so much for sparing time and joining us today with your views on TCS and, of course, what to anticipate from Infosys as well as it reports results in the next couple of weeks. I take a short break. The management of Bansal Wire Industries joins in on the other side to discuss the road ahead and a lot more. Stay tuned. We'll be right back.
Welcome back. The next company on our radar right now is Bansal Wires. Now, the reason we're talking to them is that some of the brokerages are getting bullish on this stock, citing that one, there is a capacity expansion underway, and two, the company is also targeting some high margin businesses, so getting into steel cord, etc. So that could potentially boost the margins going ahead. Pranav Bansal, the managing director and the CEO at Bansal Wire Industry, is now with us on the show. Pranav, thank you very much for joining in. Before we get chatting about, the two things I spoke about, just talk to us about FY26. Do you maintain the 25 to 30% volume growth, and what are you likely to do at the EBITDA and PAT level this year?
So our guidance for this year is definitely the same. We will try to do our best to get a 25-30% kind of a volume growth. The market is good for us today. We see good demand coming from our customers, so that should not change. Similarly, EBITDA should also increase. We are looking at some product mix change, of course. We will have more low value added products that we will be selling this year. So our EBITDA should also increase by about 10% also this year.
That should increase by?
10%.
Okay. EBITDA, the absolute number will increase by 10% is what you're saying.
Absolutely.
What will the margins look like? What will the margins look like since you're looking at adding more value-added products? How much will that be as a percentage of your overall revenues by end of this fiscal year?
So by end of this year, we are looking at 20-25% of our revenue coming from high value-added products.
Okay, and what?
As and when we add capacities for products like steel cord and other high value added.
So what does that do to your margins?
Gradually, over a period of 3 to 4 years, I think we are looking at some margin expansion. In terms of EBITDA per ton, we are looking at about 6,500 rupee level this year, which should gradually go up to maybe 8 or 9-ish kind of a number in the coming 4 years.
So, Pranav, just explain. Volumes will go up 25 to 30%. What will the revenue go up? Because your EBITDA growth is only seen at 10%.
Revenue might not go up by the same number because, again, revenue is all a matter of my volume. The kind of product that we sell gives us a very different kind of a revenue number. This year, our thought process is to sell more of low value added products, increase those numbers more. Therefore, revenue might go up to about 20-25%. But all of this depends on the raw material prices.
But then shouldn't your EBITDA go up if your revenue at least goes up by 20%? and you're focusing on some high value, then shouldn't the EBITDA growth also be at least more than 20%? Why are you guiding only for 10% this year?
So we have taken a 3-year strategy, wherein this year our thought process is to capture market share, which we have not been able to in the last 2 years because we did not have much capacity. From this year, because of the new facility that has come on stream, we are targeting a higher volume growth, and we will be a little aggressive in terms of our margin profile when we sell. Next year, however, we will try to bring that number to the same level of revenue growth. And the year after that, which is FY28, with our backward integration initiative and with high value added products, this will further improve. So this is the 3-year plan. The first year is volume growth, second year is stabilization, and third year is going to a new and a better number.
A couple of questions, Pranav. You mentioned that you are aiming for a change in product mix towards more value-added products. Which is the segment that you would pay more emphasis to? Because currently, auto is the bigger segment that contributes to your mix, followed by infra and then engineering and then durables. Where does the mix change? And part 2 of my question is, you had also spoken about gaining market share. What is it currently and what are you aspiring to achieve?
So in terms of market share, in FY24, we were at about 6%, 7% kind of a market share. We are looking at grabbing a 10% market share in the next 3 to 4 years, whereas the industry is growing at about 8 to 10% as well. In terms of product mix, we are looking at steel cord and some other specialty wires like induction tempered wire and oil tempered wires to contribute to a better margin for us. Similarly, in terms of industry also, I think the main focus will still be automotive, which is our largest end user even today. That share should go up.
So,
which will drive.
Yes. Pranav, you're saying specialty wires will be a big driver in coming times. You said the margins are higher as well here. Is it already there in the value-added products mix that you told us about? Plus, when we say the EBITDA margins are better, how much better are they? Because one of the brokerage notes suggests it could be 20 to 30% versus 4 to 6% for commoditized wires.
So again, for us, how we look at our margins are more on return ratios. We target a 20-25% kind of an ROE earlier. Now our target for ROC is 20-25%. So any product that gives us 20-25% ROC for us is the right product. In percentage, it might be more or less in terms of percentage of revenue. Specialty wire also in terms of ROC would be similar. In terms of absolute EBITDA percentage, it might be at that range.
Okay. Very, very quickly, Pranav, what's the progress on your new products, steel cords? Very quickly.
So steel cord is going good. Our pilot project is already underway. We started production. Samples have already gone to some customers, and we're waiting for approval, which will come to us in the next 12 to 15 months.
All right, Pranav, thank you so much for sparing time joining us today, and wish you good luck for the rest of the year as well. We'll take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC-TV18's all-new app, where you can get access to instant news, breaking news, in-depth articles and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up in just a bit on your screens to download the app on your phone. Take a short break and we'll be right back on the other side just as the QR code appears on your screens. Welcome back. Still near the lowest point of the day on the index. Now 180 points lower is where the Nifty stands at 25,170. Still fighting to hold that 25,150 mark on the downside are the bulls, and they would be hoping that that level at least is defended at the close of trade. The big mover of the day though is Glenmark, and started off in a 10% circuit, now has gone up to 15%, and it's continuing to be the top performer of the day. In fact, now it's gone up to almost 20% now as we speak. So the stock, possibly the stock of the day, has to be Glenmark. Some of the other movers then, Anand Rathi Wealth, of course, an earnings reaction there, 5% higher on that stock. in reaction to the moves seen in Glenmark. The other one that has moved in tandem is Wockhardt, and that too at one point was up almost 7.5%. Has given up some of those gains. It's still holding on to those gains of around 4.5% as we speak. And Ireda, of course, was down around 6%, so some recovery from the lows there as well. And Z Entertainment, 3.5% lower, the big newsmakers of the day. In fact, if you take a look at the week-to-date basis, the worst performing stocks this week on the Nifty 500 have mostly been the capital market names. If you take a look at BSE, is down 9% this week, MCX is down 8% this week, and some of the other names like Indus Towers, Sona, BLW, Bharat Forge, they also have seen losses of anywhere between 7 to 8% as the week has gone by. Titan has been the big underperformer this time, around 8% lower this week as well after that business update that it put out. So plenty of losers in the broader markets, although the index is still fighting to hold those lower levels.
You know, there's one stock, Tata Tech. It comes out with, it's a peer of, Tata Elxsi, because both of them are present in the automotive ER&D space. So Tata Tech is actually up close to about 0.8%, and it comes out with numbers on Monday. So on Monday, you have numbers from HCL Tech and Tata Tech. And I was just checking the estimates. My poll suggests that Tata Tech's revenues are likely to fall by 6.5%. But the stock is holding up in the green. Perhaps, I was just seeing year to date, Tata Elxsi is down 12%, while Tata Tech is down 19%. So maybe it's already fallen. In the last 1 year also, Tata Tech has underperformed Tata Elxsi by nearly 15%. So maybe a lot of the bad news could be in the price.
In the price already. But again, we'll come to you for the analysis, what's going to happen there. We'll do one thing. We'll wrap on this edition of Trading Half an Hour. But stay tuned. Halftime Report is up next with a lot of buzzing names and the market updates as well. Stay tuned.